Hello investor, welcome to my channel. Today's topic is high P stocks, opportunity or trap. Disclaimer, we are not SEBI registered analysts, stocks are not recommendation and this video is for educational purpose only. Now, what is PE ratio? PE ratio is price to earning ratio. It shows that how much investors are willing to pay for rupees 1 of a company's earning. It is calculated as price divided by earning per share. So PE ratio, it can also be calculated by market capitalization divided by yearly net profit. Now, the PE can be high or low. High PE suggests that there is high demand, high growth and overvaluation. And similarly, low PE shows that there is low demand, low growth and undervaluation. We will discuss about high PE stocks in this video. Now, would you invest in a stock which is trading at the level of 100 PE? Sounds crazy, right? But what if I told you that some of these so-called expensive stocks made investors millionaire? Now let us decode the mystery behind high PE stocks. So high PE we will consider the PE above 100 in general or greater than the industry PE. High PE is seen in demanding sectors like semiconductors, solar sectors nowadays. Now we see the example of Titan. Titan, all you know, is a multi-bagger share. If you look at the chart of the Titan, you can see there is continuous growth. And if you look at the P ratio, it was trading at the P of almost 190 or 198, and still after that high level P, you can see that stock continued to grow consistently. Later on, earning increased and P got corrected. You can see it in profit and loss statement. See, there is year on year growth. So due to this, high P was an opportunity. Second example of Kernex Microsystem. This is a recent example. It is an semiconductor stock. So naturally demanding high PE. It was trading at the PE of more than 300 few months ago. Later, if you see the March 25 result, the total profit came at 33 crore. Lifetime high earnings. So earning increased, as you know, in the PE ratio earnings are in denominator. If it will increase, the PE ratio will decrease, and now it is trading at the level of 40 and it seems that it is fairly valued. So now in case of Kernex Microsystem, please, this is not a recommendation. Future journey will be decided by the earning of the company. Okay. Now we saw that high P was opportunity in these cases. Now we see another example, Worry Renewable. Now this stock was trading at the P level of 260 in April 24. Now, as I said, high P means investor expects high growth. So at this level, there should be high growth. Now see that what happened after April 24. The March 24 result came. That was 51 crore against 64 crores. So there was decrease in quarter on quarter profit. So this high PE level did not meet the expectations. Now you can see that PE got corrected and stock also got corrected from the level of almost 2700 to 800. So the IP was an trap. Now we see that Adani Enterprise. Now we are discussing these are fundamentally strong stocks. We are talking about the valuations. So at the time of investing, there is very important that you invest at the fair value of the stock, even in case of fundamentally strong stocks. Let us see the example of Adani Enterprise. The stock was trading at in September 22 more than 400 PE level. So simply this was an overvalued stock. Why? Because if you see the profit growth from 21 to 22, there was no growth in profit. Still, it was getting a high PE level. So simply this stock was overvalued. Then came the Hindenburg report. All of you know that, and the stock corrected like nothing. So the Hindenburg did not tell you anything new. It just caught the attention of investor that this stock is very high valued, and it caught the attention of investors, and the stock got corrected. Now it stands at the level of 66p. So the high P stock was an trap here. Again, Adani Enterprises is fundamentally strong company, but for this also was a strong company, you should not buy at this high PE level. So if you see the high PE stock, always see that there is correlation with the profit growth. If the growth does not meet expectations, the stock can crash and lose your hard-earned money. Like these two examples, see. So how do you judge? Look for consistent revenue and profit growth, industry leadership, and future growth potential. Just make it simple that high PE stocks should deliver high growth. Otherwise, you are going to see corrections. Now, this high PE stock are not always bad, but they demand higher scrutiny. If the company delivers higher growth, there is jackpot. If not, disaster. So before investing, always ask, is the price justified by the future growth? So this was all about today's video. If you like this video, hit the like button, share with the investor friends, and subscribe for more insightful content on stock and markets. See you in the next video. Thank you.